Good morning, real estate mindset community, and welcome to another morning live. Happy Wednesday. We got some great info to go over today. We have a new record high as far as my career, as far as interest rates. So, new record high interest rates. We'll see what impact that's making on amortization schedules and payments. We'll look at a few videos, and then towards the end of this video, we're going to do another market analysis. And don't worry, y'all, this will be chaptered. So, reference the market analysis later on if you need to. And I just wanted to let you guys know, I've been really, really proud of so many of you. I hear you guys are increasing your credit. I hear you guys are rebudgeting and saving money. But one thing I think as a community, as a real estate mindset community, where we're falling a little bit short is understanding how a market analysis can work, and also understanding real estate is hyper local. So anyways, I want to make sure that you guys are understanding how I'm using the data. Unfortunately, I know it's going to be hard for some people because you generally have to access MLS because we need comp data. We need sold home data. But regardless, I'm going to show you guys how to do that. We'll find wedge, we'll find cash flow, and we're going to do the subdivision of Oak Ridge North at your request. You guys wanted me to do Oak Ridge North, so I'm going to do that. But let's get started right now and get into our market update. Let me do my first timestamp right now. So take a look at this, guys. We're going to start by talking about the this one's crazy, but we're going to start talking about the likelihood of recession and what, the Federal Reserve is saying, what Wells Fargo is saying, or Bank of America, Goldman Sachs, consumer and economists, just so we kind of see where everyone's at with this whole recession thing. Take a look at this, guys. Alrighty, so here we go, and it is visualized for you. Now take a look at that. This is absolutely insane. This is a little bit old. I think this goes back to August. Now look at this. It's saying the Fed staff, okay? So the Fed staff is saying that we have a 0% chance of recession. But what did we hear, last week was it? When Jerome Powell talked, he basically said a soft landing, or rather a recession, is not our baseline. So we really can't look at this because the Fed's job is to keep us calm so they can continue to boil us alive. Isn't that fair to say? So take a look at this. According to the yield curves, okay, so just looking at the yield curves, according to this article, shows us giving us basically a 61% likelihood of recession. I'll argue it's actually 100% likelihood when we look at the 3-month and the 10-month inversion. In fact, if we just look at the yield curves, if we don't go into recession, it will be the first time we don't go into recession with the type of inversion that we have. But regardless, 61% chance recession if we're just looking at the yield curves. More than half likely, right? Now, economists, which are almost completely useless, unfortunately, are estimating a 48% likelihood of recession. And again, economists are unfortunately completely useless. All we're going to hear from them is supply and demand, supply and demand. Now, consumers are starting to wake up, because look at this. Consumers are saying, or Main Street rather, and when I say recession, what I'm saying is unemployment. So let's stop saying recession. Let's start saying unemployment, because that's what we're monitoring for the housing market. Okay. But consumers are saying 69% likelihood. That's crazy. Now look at bullish Goldman Sachs. Going against the trend here. So Goldman Sachs is saying 15% likelihood of a recession. Bank of America is at 35 to 50% likelihood. But CEOs, look at this, guys. CEOs are all but convinced we're going into recession. CEOs have us at 84% likelihood. And again, this is a little bit old. I think if they would have reviewed like the updated interest rates being 7.7%, the 10-year skyrocketing, I'm pretty sure all of this would change. But this is a way to visualize it. Now, this also breaks down the bull case and the bear case, which is interesting. So in a nutshell, here's the bull case. Consumer spending, which accounts for 70% of GDP, is underscoring the economic optimism. So the bull case is people are still spending, the consumer is strong, the economy is strong. That's the bull case. And then I would also say, what about the money printing this year? So included in the strong economy is the Fed put. And the Fed put means when something goes bad, they will bail out the economy. So that's the bull case. Now, the bear case is this. Household debt hit a record $17 trillion, with corporate defaults accelerating into 2023. So a whole bunch of turmoil. The bulls aren't really looking at that. Bears are looking at the turmoil behind the scenes. So that's kind of the breakdown there. Let's go right into the 10-year, see what activity we have in the 10-year. Here's the bad boy right here. This is what everyone's talking about. Here's the economic pain, or one area of economic pain. Now, yesterday, it was so crazy. After our live, it like doubled as far as the basis points that it went up. So I think yesterday we ended double digits up on the 10-year treasury. And when the interest rates updated, it did not take into account the full, increase on that 10-year. But what's interesting is this morning, you guys can see that this has been going down since about 7 a.m. All right, so this is going down. Probably a result of the ADP job numbers that came out. So ADP job numbers came out, but regardless, do you remember how much we were wanting this to hit 4% at the beginning of this year? Do y'all remember my 1-year anniversary, which was, when was that? March of this year. So our 1-year anniversary on Real Estate Mindset, I've been doing this about a year and a half. We finally hit 4%, and then the bank runs, and then the bailout, and then it dropped again. So it kind of goes to show you like how bad that bank bailout was. Because look at where we're at right now. So we're well into the 4%. Now take a look at the 6 month. Okay, so here's the 1 month treasury. The reason why the 1 month treasury is important is because more than likely the money that's here, and this is the overnight reverse repo. This is like a lot of I would say that there's still a lot of COVID money in here, maybe some excess savings in here, right? This is a lot of liquidity, and we want the liquidity to leave this. We want to leave the market, right? Quantitative tightening, burning the money supply, things like that. So I just wanted to show you that it has been going down slightly. And again, the reason why this is going down once again is because the banks can get a higher yield. Well, it depends where this ends up today, but they can get a higher yield on that 1 month treasury. So they pull money out of the 1 day, they throw it. Usually they throw it in the 1 month, could be the 6 month as well. Now, here's the insane thing, guys. Take a look at the inversion. Okay, we've been watching this inversion because this is warning us of the recession. Okay, so this is the 10-year and this is the 2-year inversion. Look at the trajectory. Holy smokes, this trajectory in 2 weeks, you guys, this is 2 weeks. So the last 2 weeks, this trajectory has been skyrocketing, not because of the short end of the yields, because of the long end of the yields. I was talking to Jeff M last night about this. This is, I believe, the first time, Jeff was saying this is the first time in history that we would reinvert based on the long end of the yield. It's freaking insane, but look at this inversion. This, I'm going to tell you what this is showing us. This is showing us that, honestly, we can already be in recession, but if we're not already in recession, this is showing that recession's right around the corner. Maybe a quarter or 2 quarters. That's the trajectory of this reinversion. Very, very fascinating. Again, the last few recessions we reinverted. So we went above the black line, and a few months later, maybe a quarter to 2 quarters later, we entered recession. Okay. But remember, we can't bank on that because the 70s and 80s, we stayed inverted before entering recession. Nevertheless, huge indicator of what's on the horizon, which is economic turmoil. Probably commercial real estate, could be the unrealized losses from the banks that have the 10-year treasuries at 1%. Y'all understand that there's still an overwhelming amount of banks with those like 10-year treasuries at 1 to 2%. Y'all, those are worth like a quarter instead of $1 now. It's the banks, especially regional banks, got murdered by purchasing those 10 years, a few years ago at 1 and 2%. Now, here's where we're sitting at interest rates. This is a record high for my career. You guys know that I've been doing real estate or in real estate one way or the other for 22 years. I started right out of high school in 2002. This is now the highest rate of my entire career. So unless you've been doing mortgages or real estate or anything in real estate for over 20 years, you haven't seen this before. In fact, I haven't seen this before, and I have a 22-year career. So I've never seen this average interest rate this high in my life. Now, this is going to bring us to the highest it's been in 23 years, highest since about mid-2000. So I was still in high school. I was still in high school the last time that interest rates were this high. This is huge, guys. 7.72 is huge. Let me know if you guys think we're going to hit 8%. I think it's possible we hit 8% this month. So I'm saying it's possible 8% this month and 5% on the 10-year this month as well. So we'll watch that 10-year, but a lot of it is going to depend on that 10-year. Now, let's see what impact the 7.72 has on an amortization schedule. So you guys see I put the average loan amount, of $328,000. Okay, so that's roughly the average loan amount. Here's your 30 years. Here's a 7.72% interest rate. And remember, this is crazy, you guys. The higher the interest rate, the less money it takes you to buy down 5 years off of your amortization schedule. But first, let's look at the amount of interest. We're now well over 500,000 in just interest. If you decide to buy the average house at the average interest rate, at the average down payment, you will pay back in fees over the course of the loan $515,000, and you're only borrowing $328,000. So what's the real interest rate here? The real interest rate is 150% or more. So again, it's not 7.72. The way these amortization schedules work, you're paying 150% in interest. Wake up, America, right? Understand amortization schedule. So $515,000. Now take a look at the amortization schedule here on the left. Now remember, we started at about $20,000. Okay, so we're looking at the amortization schedule because what I'm trying to explain to you is you got to conquer your loan, and you only get the loan after you close. Okay, so this has to be done after you close. Say I close, then I call the lender up and say, hey, I want to put down $15,000, $20,000 on my principal. Okay, thank you, goodbye. That's how you do it. You got to call them after you close. But remember, it used to take $20,000 to get us to pay off 5 years. Now, you guys, to take us to this 5-year mark right here, it's only, this is crazy. Listen to me. It's only $16,000 now. It's still a lot of money. I get that, but $16,989. So we are under $17,000 now. Do y'all see the power of interest? So anyways, if you guys pay a little less than $17,000 down on your loan from day one, again, you pay $17,000 down from day one on your loan, y'all save 5 years. Okay, so you save these first 5 years because you pay your balance down. You can see here to $311,000. Now that's going to save you. This amount also goes up. So that's going to save you now even more. So it takes less to save more. Do you see? Less to save more because the power of interest. So you would save $123,000 over the remaining life of that loan. So again, you put down $17,000, y'all save $123K. Okay. And again, remember why that is. Look at this. Okay. It's front loaded with interest. If we go to the ending years of the amortization schedule, you can see that way less money over the year. Okay. So this is the entire year of payments. Year 28, only $4,900 goes towards interest. Year 29, only $3,100 goes towards interest. But again, year one, $25,000 goes towards interest. So if you guys want to be super savvy and all this type of stuff, work your amortization schedule. It will save you a ton of money. Now let's look at the affordability factor. So we always look at, if you're making $100,000, what would the average person qualify for at today's interest rate? The way I set this up is I put the annual income here. You guys could do it yourself if you have your W-2s or your paycheck stubs or whatever. 30 years, 7.72. The average consumer has $1,400 in debt payments per month. So hopefully you're not average. Hopefully you're above average, because this $1,400 in monthly payments kills purchasing power. Now, average down payment is 18%. Property taxes, I added the $500 in HOA fees, and I always drop this down and select 45% DTI. All right, let's calculate. Okay, so the average person that makes $100,000 a year only qualifies for a mobile home. I'm sorry, specifically $293,000 home. But not only do they only qualify for $293,000, in order to close on that home, they have to put down roughly $61K. So again, they got to pay $61K just to move in. Their payment is of roughly $2,700. But remember, we talk about consumer debt wrecking purchasing power. So again, right now we qualify for $293, but when I remove this monthly debt, okay, say this consumer has no monthly debt, we go from $293, let's recalculate, to $471,000. So again, listen to what I'm saying. This is huge. The average consumer, if they're making $100,000, the average consumer is losing $180,000 to $190,000 in purchasing power. So that's why I always say one of the biggest things at affordability is you, right? If you have no consumer debt, you have optimal purchasing power as long as your credit's good. So in other words, no consumer debt. It is literally like, it's a trap, you guys. It's a trap. People are enslaved by, especially credit card debt. A mortgage, a 30-year fixed rate mortgage, we could do some stuff about it. At least it's attached to an asset that's supposed to appreciate. But when it comes to credit cards, it's way worse than what I just showed you. So put that in perspective when you're using your credit card to buy things that you don't need, right? But anyways, Let's go into our first video right now. Now, our first video, this one, that's right. So this is the first video. Is going to be a very brief video, and it's going to be basically on home builders. And I just got done doing a video on Warren Buffett because remember, oh, Warren Buffett, he doubled down on the housing market. He bought all these stocks. So I just did a video before this to show you guys, was Warren Buffett right or was he wrong? Because they're only down 13%. What is that, 100 million or 10 million? I don't know. Anyways, let's listen to home builder sentiment right now. If you guys can, please let me know that the audio is okay. It's only a minute long.
Rates are on the rise. Diana Olick is following that, and you can see the residual impact, on the housing stocks, the home improvement stocks. I mean, right in the wheelhouse of the things you look at every day.
Yeah, all of it, Scott. Housing stocks are seriously having a rough day, and not just because of the broader market. Higher bond yields today mean higher mortgage rates. The average rate on the 30-year fixed jumped to 7.72%. Mortgage rates follow loosely the yield on the 10-year Treasury, which has been climbing this week on strong economic data, and specifically that JOLTS report today. Rates have not been this high since the end of 2000. Higher rates have crushed affordability, hitting both new and existing home sales market. Take a look at the builders, which are Horton, Lennar, Pulte, all down around 3%. And Zillow Group is also down around 7%. The builders had been benefiting from the lack of existing home supply, but higher rates are just killing them. Builders' sentiment is now in negative territory for the first time in 5 months, Scott.
Wow. Yeah, it's hard to be optimistic when you see mortgage rates, Diana, do what they're doing as we have this conversation. I appreciate it very much.
All right, so we see that, I mean, the mortgage rates are starting to sink its teeth in. This happens every single time, and I listened to a whole bunch of people, but what's incredibly powerful is the sentiment out there is, and this is crazy to me, guys, okay? This doesn't even make sense to me. I'm sorry for my focus. Is my focus okay? All right, sorry. Is how powerful the emotion is in the market. I mean, the Federal Reserve tells us they're making sure that the expectations for inflation doesn't get unhinged. So I can't believe how powerful that emotion is. And look at the fear of missing out, which again I've never seen the fear of missing out that bad. I've never seen people waive contingencies. And I mean, appraisal gap was a household name. The housing market was incredibly toxic for the last 2 years. So anyways, let's go into Lennar and let's see how Lennar is doing real quick. I'm going to go into a couple updates on the stock market. So here's Lennar. So what is this down? So it's down about 12.5%. So the next time someone asks you oh, what about Warren Buffett? Blah, 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 blah. Well, he's down 12.5% and we're heading into the fall and winter. At least that's with Lennar anyways. Again, we're heading into fall and winter. Okay, but take a look at the Dixie. So someone wanted me to add the Dixie to our updates. The Dixie is basically, the Dixie is the strength of the US dollar to the world, right? So it's like comparing to the world. So if it's 100, whatever, it's about even or whatever. But right now, you guys, the Dixie is at 106, and that hurts the world. That means that the value of the dollar is not going down, despite what we hear about the BRICS, CBDC, they're going to replace the dollar, blah, 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 all of this stuff, which is very interesting. They are legitimately moving towards that. But who the heck is going to replace the dollar? There's no one in the world. And that's actually puts the U.S. in a situation to where I believe that they're bullying some people, especially Australia. I won't get into that. But the Dixie is at 106.72. This has been surging. Let's see how much we're up over 3 months, up about 3.25%. This has big impacts on the world, obviously, because the dollar is world currency. Let me show y'all VIX. Oh my gosh. Y'all see this is down 3%, but what you didn't see is yesterday, this sucker was up what? Anyone know? Yesterday, what was the VIX up? I think it was up 13 or 14%. Now remember, the one stock I said that I wanted to buy, and I actually transferred money into my brokerage account, but then I was like, no, Travis, you got to be a good example. I don't want to take any high risk. So I never invested in VIX, but it was at, I think, $13 or $14 when I first told you all about that. It's at $19 right now, which let me see, that's up. Oh my God. Again, this is no stock advice. Don't ever listen to no stock advice from me. But this is up 32% since I told you all that. 32%. Okay, this is showing us the economy is in bad shape. So when it was $13, I'm like, how is it at $13? That's like a historic low. Anyways, the people got it so wrong. So wrong, in my opinion, like they always do. We're going to go into our next thing. Okay, our next thing is basically going to be Wells Fargo. That's going to go into basically the bond yields, the explosions of the bond yields, They're going to talk about like, okay, now that the bond yields are so high, when will things start to break? Things like that. Again, we're seeing the bulls start being a little bit more bearish, a little bit more dovish in what they're saying. So let's pull up this video and let me get my timestamp for you guys. I'm making some good time, I feel like. I want to get to that market analysis. Let me know that the audio is okay, please, guys.
Joining us is Wells Fargo's Sarah House. I mean, we are looking at these yields making new cycle highs as we speak. Got a surprisingly strong job openings report. How much higher can yields go?
Well, I think what we're seeing is this reaction to the economy not just hanging in there stronger, and that's affecting expectations for what the Fed does. But I think a lot of the supply considerations that you were just discussing. So everything from the current position of the deficit, but also QT ongoing. And so I think, it remains to be seen just how high, but I think a lot of it's going to be affected by also what the Fed path does from here. And what the latest economic data suggests is that certainly higher for longer. And I think it really keeps the potential for perhaps one more rate hike this year on the table.
So beyond that, Federal Reserve's talking about higher for longer. It'll rest right on the economic data and the inflation data. So where does that go? Does the tightening of financial conditions that we are witnessing now in terms of rates and the dollar and everything else do the work for the Fed so that they can get on to cutting faster?
I think it certainly does help. So this is one thing that we hadn't seen throughout this entire tightening cycle is the Fed would be raising rates, but we would actually see financial conditions ease during periods. And so I think there was this idea that, well, if financial conditions ease, the Fed can either just keep at it, keep rates elevated for longer until you see that pass through, and that is what we're seeing. And so I think, yes, to some extent this does the Fed's work for it. So that's by design. The Fed's interest rates work through those financial channels. And when we look at, I think, the tightening we've seen in financial conditions, that suggests that we haven't seen the worst of the slowdown in growth. And while prospects, I think, have improved over the past few months for a soft landing, the debate is far from settled with these real rates, I think, likely to further dampen growth.
And you say that there's going to be a slowdown in train. We have seen things like the leading indicator has been pointing that way for a very long time. Growth has continued to surprise to the upside. Where do you actually think we're going to have that final point where things become too much, frankly, for the economy? And is the Fed really looking for that? Because they have said that they're obviously looking to be restrictive in their policy. At the same time, they upgraded their growth estimate for next year. It's still below 2% real.
Yeah, so I think a real test here is going to come in the fourth quarter, where you do have accumulating headwinds. So not only do you have the ongoing headwinds from tighter monetary policy that is increasingly restrictive in real terms, but you have this increasing effect of the fading fiscal support. So everything from that continued wind down in excess savings, the restart of student loans, the child care cliff. And so I think you are going to see consumers increasingly squeezed, with perhaps a bit of a jump in that dynamic here in the fourth quarter. But I think it's really the slow squeeze that we're looking for, where we think things continue to moderate as we move through the first part of next year.
Alrighty, so they're thinking fourth quarter pain is what's coming. Let me know what y'all agree, and also let me know if you guys think that we could make it, through that long. So obviously, we want to make the longer that we can hold where we're at right now with the higher interest rates, quantitative tightening, the better. Remember, we don't necessarily want any type of bank bail or any type of bailout for that matter, because it will hurt us even more. Now, just to put this in perspective, obviously we had a horrible inflation crisis, right? That's why the interest rates are being risen right now. And the problem with the inflation that we have right now is a lot of that is in shelter, and shelter is incredibly sticky. It's incredibly big. It's slow moving. And if you really look at the way that they raised the interest rates, they knew this was a massive problem. I believe they knew that this wasn't transitory. If they thought it was transitory, why such an aggressive action? And to me, again, this is showing us we can't trust the Federal Reserve. Or rather, if we look at it a certain way, we can trust the Federal Reserve to say whatever they have to say to keep us calm, Do y'all agree with that? Well, let me show you the trajectory of the interest rates. Okay, so here's a nice little chart right here. I love these little charts, you guys. Just to put things in perspective right now, all right, this is the fastest and highest from the start of the rate that we've ever had as far as rate hiking. Again, this is the most aggressive rate hiking we've had in history. And so there's nothing wrong with the housing market, guys. I mean, probably the reason why this is like that is because everything started breaking fundamentals and it's not sustainable, like PE ratio, payment ratio, equity buildup, things like that, right? Look at the aggressive run up. It's in orange. I think this is orange. Let's just call this high. You know what? What was Sunny D? Y'all remember Sunny D? I'm a 90s kid, 80s baby. This is Sunny D color right here. But look at it. Massive, massive increase of interest rates. They did it in a shorter period of time. And what's very intriguing is it actually greatly exceeded 88 and 89. So during the late 80s, not the early 80s, it exceeded. Do y'all see that? We're up about almost 500 basis points. That is in what a month or about a year and a half? That's crazy, you guys. So let me scroll down here just to put this in a chart form so you guys can see. And I highlighted it a little bit here because I wanted to, let me zoom in. I know you guys can't see that. Okay. There. I think you can see that better now. So take a look at this. All right. Now I'm looking at not only the change in percentage points, but also the duration. Because do you guys remember all the loan officers and bulls on YouTube that were saying that rates were going to be 4 and 5% this year? Do y'all remember? Like everyone was saying that. And the reason they're saying that is because they want the leads so that they could make money. That's why they say what they say. But they were wrong. They were dead wrong. Now, just to put this in perspective, guys, during the great financial crisis, which is here, it's the top one, we had 24 months of tightening. All right. But back in 2015 and 2018, you guys probably didn't know this. We had 3 years of credit tightening, you guys, 3 years. Okay. We're only in 14 months right now, actually a little bit longer. According to this, 14 months is actually, what is it? 18 months. So we're about 18 months right now. And look at the amount of change, 4.88. So that's 488 basis points. So again, what I'm trying to explain here is inflation is a problem, and the Federal Reserve knows that. They're probably aligned to us. And the other crazy thing is despite all of the headwinds that we can now see, the writing on the wall that we can now see, inflation's still here, and more work needs to be done. The reason? The money printing. Right? We know that the money printing, the low interest rates, but take a look at the break-even inflation rate. Okay. It's still elevated. We're still at 2.21. I mean, it dropped slightly. It dropped 2 basis points yesterday, but this bad boy ain't going down. And the Fed needs this to go down. This is the expectations that they're always talking about not becoming unhinged, right? This is what they're watching. So right now we're at 2.21. This needs to be under 2 before I'm going to say they can confidently start lowering interest rates. Now, remember CME Fed Watch? This is the anticipation of the market on what the Federal Reserve is going to do. So when Dave Ramsey says, we don't know if interest rates are going to go down, he's wrong, because the Fed has told us they're going to go down. They have the dot plot. They tell us it's going to go down. That guy's I don't want to offend anyone. I'm sorry. But anyways, we know rates are going to go down, but they're not going to go down very quickly at first unless there's a black swan. So all I'm looking at really, guys, is I'm looking at in the future. I want to make sure that we get through buying demand seasonality in 2024. So we don't have to hear these trolls talk about seasonality anymore. And by the way, if anyone says to you guys, if you hear someone saying that all of this is because of seasonality, this is what I want you to ask. Okay, if it's all about seasonality, do you think it's going to be 5 times the average seasonality for price decline like it was last year? Because remember, last year, if we're going to just talk about seasonality, which is crazy to just talk about that, last year we had 4 to 5 times the price decline of normal seasonality. So to me, that's not really seasonality, right? That's the Federal Reserve doing stuff, rates going up, right? People can't afford a house. Hello. But if they say it's just seasonality, ask them, do you think it's going to be 5 times the average like it was last year? Mr. Seasonality, you guys got to stop listening to accountants. I don't know how else to say it. Stop listening to accountants. But let me go back here. Okay, so I'm looking at next year buying seasonality being crushed. We want to have elevated interest rates. So I'm looking at July. July was about a little less than 50% likelihood of elevated interest rates. It's actually gone down unfortunately, to about 33%. So this is saying we have about a 33% likelihood to have interest rates elevated. But even if they start cutting rates, it's only, 25 basis points, 50 basis points. So more than likely, what I'm trying to say is when they do start cutting interest rates, it's not going to be massive interest rate cuts depending on what breaks. If something real bad breaks, they're going to do some pretty sharp cuts. If it's just a little breaking here and there, they're going to do 25, 50 basis points. And rates for residential mortgages, they're not going to plummet down. It'll probably take mortgage rates a period of years to come back down to, say, 5%. Again, what does this depend on? You should know this. It depends on the black swan, right? It depends on the black swan. Now, let's listen to this next video we're going to go into right now. And this next video is from Black Knight. And remember, in House Hacker, I'm going to pull up your comment in a minute because I like what you were saying yesterday on a comment, House Hacker. But anyways, we're going to listen to Black Knight, basically going to talk about the gridlock in the housing market because of interest rates. And what's really crazy is, remember, about a month and a half ago, this guy was coming on all these stations talking about how, yeah, we hit record highs. The housing market's still strong, cheerleading like crazy. And I'm thinking like, dude, like prices of houses just started going down. Like, what's wrong with you, maniac? Like, they're going down right now when you're saying all this stuff. So let's hear his attitude now, because his attitude is starting to change. Let's play this video. Hope you guys like it.
Both of you. Diana, what are the headlines?
The average rate on the popular 30-year fixed just hit 7.72%. That, according to Mortgage News Daily. Mortgage rates follow loosely the yield on the 10-year Treasury, which, as Kelly said, has been climbing this week on strong economic data. Rates have not been this high since the end of the year 2000. It's all thanks to stronger data than expected to start October. Today, the JOLTS report is pushing yields higher. Higher rates have crushed affordability, hitting both the new and existing home sales markets. While builders had been benefiting from the tight supply of existing homes for sale, higher mortgage rates are a major concern now. Builder sentiment slipped into negative territory in September for the first time in 5 months. Now, to put these rates in perspective, for a borrower buying a $400,000 home with 20% down on a 30-year fix, the monthly payment today is about $930 more than it was when rates were at 3% during the height of the pandemic. And Kelly, that is real money, and that is having a very chilling effect on home sales.
And Andy, I'd turn to you because a lot of people have said maybe the nascent hoped-for rebound in the housing market is now evaporating, especially after the latest round of housing data.
Yeah, I mean, when you look at the latest housing data, it was red hot coming into August. We hit a fourth consecutive record high. We're 2.5% above last year. Annual home price growth rate, which is kind of that headline number everybody looks at, was effectively flat back in May and then re-accelerated to 3.8% and was ready to push higher. But you're absolutely right? Buying power is down roughly 6% from when those numbers came in. So it could take some of the steam out of what had been a pretty hot housing market this summer and heading into the fall.
So when we say take the steam off, Andy, so far the market's been kind of frozen. If anything, the Fed's hikes have been pro-cyclical, where inventories shrunk. The prices have stabilized and started to rise. Do you throw that out the window now?
A little bit, right? I mean, absolutely. When you look at the demand side, it's affecting it as you would expect. Demand has hit kind of its lowest point during the pandemic over the last 3 weeks. Certainly kind of constraining the market and affordability at its lowest level in 40 years. At the same time, that same interest rate lever that's driving down demand, as you just mentioned, is pulling down supply. And we're actually 8% below where we were last year in terms of supply. 70% of markets are down year to date on a seasonally adjusted basis. And so, it is causing that gridlock in the market. You're seeing this constrained demand and further constraint expected from these rising rates. But the big question when it comes to how will the market react is, what's inventory going to do? Are we going to see any kind of inventory building here over the next few months? If so, yeah, it could cool prices down. If not, you're going to just see this stalemate play out in the market.
Diana?
But Andy, I was wondering also, we saw prices actually pull down at the beginning of this year when mortgage rates were actually lower. Prices then started rising this summer when mortgage rates were rising, which is not the way the housing market usually works. When is that dynamic going to change, as you said, that we will see prices fall? And if so, as you were just saying, how much do you think prices can come down?
I mean, there's the potential to be a lot. I just don't think we'll see it. And again, it comes back to inventory, right? So if you look at home affordability itself and what it would take to normalize the market today,
There we go.
it's a 35% correction in price, or a 4% decline in rates, or a 55% growth in income. Some combination of those. Those are massive movements that we're talking about. And none of them are going to happen in a vacuum, and none of those one single factors is going to make the move, right? So there's this big potential for movement. There's this, this view that housing is overvalued. The problem is that the lack of inventory is keeping those prices very, very sticky when they should be pulling back. And, we just haven't seen that inventory build. Now, in the last few years, there's been this late year kind of, above seasonal average growth in inventory. And that's what we're going to be really watching over the next few months. Do we see what we saw in late 2021? Do we see what we saw in late 2022, where you started to see that inventory build and prices soften? We've started to see some hints at it, but haven't seen a big move yet. So we'll be watching that inventory data really, really closely, because that's really going to tell us where home prices are going late this year.
All right, that's a great point.
All right, good stuff. You guys see how much different he's being as far as like how bullish he is? I mean, and other things that I like that he was saying is basically, if we look at the fundamentals here, we would need prices to either go down 35% now, or we would have to have an increase of 55% in income. That's absolutely crazy. And I also like how they're now acknowledging the fact that we're probably going to get more inventory this season, late in the season, which we don't typically get. Now, I want to show you guys something that's really cool, but real quick, okay, so this comment right here. So TVL, here's what I want to say, brother. Like, my channel's not for you, man. Just to remind everyone, the reason why I even created this channel is to talk to the consumers, normal consumers. We don't have millions of dollars in liquidity and can really take huge, giant risk. So I just wanted to say, TV, like, in my mind, the worst fear mongering, if you will, is saying, just buy a house, values only go up, marry the house, date the rate. To me, that's, that's the bigger fear of missing out. But just to let you know, man, what I'm not talking to people like you. I'm talking to the little guy, because that's what matters to me. You don't matter to me. If you got millions of dollars, like, do your own thing. We're talking to people on the bottom. And unfortunately, TVL, as you probably know, I'm not a millionaire. Maybe one day. I don't know, maybe one day. But the thing is, guys, a lot of people are bullying us for saying that because of who knows why. I have no idea why. The thing is I already went through this. I had my own foreclosure, my own bankruptcy, my own repo, and it hurt. And not during. It hurt. The aftermath is what hurt me so much. And I know maybe I'm a little bit biased, but now this is going to be crazy. Take a look at this. All right. Now, this is crazy. We're going to talk about the trust of the Federal Reserve. And I'm going to show you guys who does society trust the most right now as far as the Federal Reserve. And I want you guys, if you can, to comment below. All right. So I'm going to show you guys. All right. Alan Greenspan, Ben Bernanke, Janet Yellen, or Jerome Powell. So of those four people, who does society trust the least right now? Again, Alan Greenspan, Ben Bernanke, you remember Big Ben? Janet Yellen doing magic mushrooms in China, whatever, or Jerome Powell. I want you guys, if you can, to comment below. Let me know who you think they trust the least. Who do they trust the least? You guys know? Who do you guys think? So if I was to guess, I'm going to show you right now, but if I was to guess, I would have guessed Ben Bernanke, because he very clearly, we have proof now, lied to us during the great financial crisis. I know that because I went through that, and it was really, really sucky. But take a look, guys. Here's what it is, okay? It's Jerome Powell. So the society has less faith in Jerome Powell than Ben Bernanke. How's that possible? Oh my God. You guys, it just really hurt in the great financial crisis. I remember it like it was yesterday, and it really blindsided me. And I was a fool for letting it blindside me. But look at this. They gave basically a 36%, we'll just say, approval rating for Jerome Powell. You guys, Ben Bernanke, his low was 40%. So during like the great financial collapse, when everyone was dead in the water, unemployment was double digits, he still had a 40% of trust ratio. Jerome Powell is under that, and we haven't even started recession. We don't even have unhinged unemployment. And that's really, I think, the biggest difference, in my opinion, between like the bullish argument and the bearish argument is unemployment. Let's just say unemployment is the thing. If we were just to, boom, all is said and done, we know the supply, we know the inventory, we know new homes, existing homes, homeowners before 2021, homeowners after 2022. We like know all of that. But from what I can see here, the biggest thing is the unemployment. And again, that's another word for recession. But thought you guys would find that interesting. And obviously, Alan Greenspan had the most love at 74%. I miss Alan Greenspan a little bit. I got into the business right after Alan Greenspan left. You guys see he left in 2006. And then Ben Bernanke came in and lied to us all. And then we entered the great financial crisis. This is crazy. So consumers are starting to get it, right? That's what I was trying to show you guys here. All right. So we're going to get into our last video. In our last video, let me do the timestamp. I think I'm making good time. And whether you're bullish, TLV, if you can, TLV, whether you disagree with me or not, and this goes to anyone, I want you guys to stick around. TLV, if you can stick around, monitor the market analysis I'm doing. And I want to get your opinion on the market analysis because it appears you're an investor. What I'm trying to do with my market analysis is basically just show consumers a very simple napkin math way to find a good deal. Now, obviously, price per square foot is not how value is determined. Price per square foot helps us to get to where we need to go. From price per square foot, we can do additional research. So if you can, TLV, stick around for that. I'm going to show, again, wedge and cash flow in under 10 minutes. All right. So we're going to do our next video right now. And I appreciate each and every one of you. As long as you guys are respectful towards each other, stay here, man. You know, you guys just stay here. Because I really appreciate the difference in perspective, and you guys should too, because when I see some of these comments, y'all, I ask myself, all right, why are they saying that? They have some good points. What do I have as a rebuttal? So it's like, if we don't take it personally, it actually strengthens us. So again, as long as we can kind of like be a little bit of respect, like, you guys, let's talk. Let's talk to each other. What's going on? Why do you think this, right? There's so much happening. I'll shut up. Here's the next video. This is from on the Fed president in Atlanta, talking about he thinks it is done. The restriction is out of control.
Meantime, one of the Fed's voting members next year is out with some new comments on the economy. Let's get to Steve Leisman with those headlines. Steve.
And important ones. Atlanta Fed President Raphael Bostic becoming among the first Fed officials to say outright he believes the current Fed interest rate is, quote, sufficiently restrictive. That's the benchmark forged by Fed Chair Jay Powell to determine if the Fed can stop and hold rates at current levels. I'm very much in a place, he told reporters earlier today, where I think our policy is sufficiently restrictive and that we can be patient. Fed Vice Chair for Banking Supervision Michael Barr yesterday said the Fed is at or near that level, suggesting he's close to Bostic's view, but not quite as definitive. Bostic's comment could mark him as an outlier on the board, with several Fed officials recently suggesting that they would favor an additional hike, and 12 of 19 members actually forecasting one more hike this year. In fact, the probability of a final hike this year rising this morning to 31% for November, 47% for December, after a strong job openings report implying continued strength in the labor market. In any event, Bostic suggesting the Fed shouldn't hike again doesn't offer much relief out there, because he went on to say the Fed should hold rates at current levels, quote, for a long time and well into 2024. Asked about surging long-term bond yields with the 10-year, as Dom just said, hitting new 16-year highs of 475. Where are we now? 478 now. If I blink, I get it wrong. He said higher rates will help the Fed restrain the economy, with corporate debt refinancing a potential drag, helping slow growth and bring down inflation. He added he doesn't believe that companies were really being severely impacted by higher rates now, and that his main focus is on the consumer. He said a soft landing within reach, but the Fed has to monitor carefully the slowing of the economy. The next rate hike, Bostic says, the next rate move, Bostic says, the end of next year, 1/4 point cut.
It's still significant. We've seen him kind of approach this thinking, but this is the first time he's come out and said it.
And I think what you have is you have those on the committee who are worried about lags and those who are not.
Right.
One of the lags he points out is the corporate debt refinancing. He says another shoe to drop in the economy.
Very interesting. All right, Steve, stay right there with Treasury sitting at decade highs.
All right. Sorry, you guys, I got caught up in those comments right there. I liked what Comic Lover was saying. So basically what Comic Lover is saying is, like, just put the money, instead of putting money towards the amortization schedule at the closing, which I'm suggesting you do, he's basically saying bi-weekly, right? Would you say that, Comic Lover? You're saying like bi-weekly or putting extra money towards principal, which is basically the same thing. pretty much, right? Except it's monthly instead of one down payment. But also, Comic, I think you're going to find it interesting. I've started doing preliminary calculations to see if you put less money down on the down payment and put more money down on the amortization schedule, depending on PMI and mortgage insurance. And when we adjust the difference in payments and add that to biweekly, it's actually you save money by doing what I'm telling you in most situations. I've already done the math on that. It's very difficult to do the math because of mortgage insurance. Because once you hit that 20% LTV or technically 22% LTV, PMI is removed, except with FHA. So it's a little bit tricky. My point is understand, I think you're missing the point, Comic. Understand how an amortization schedule works. And if you do have money, tax return, maybe from a tax return, throw that sucker in the amortization schedule. You still get the money back because you're just paying the loan down. The point that people are trying to make is your payment doesn't go down when you do that. But if you put more money down for a down payment, your payment goes down. But to put it in perspective, if you guys put $50,000 down, what does your payment go down? Do y'all know? Maybe $100. So $50,000, $100, $150. That's not a big deal. Maybe it is. Maybe it is. So here's what I'm going to do next. Okay, we're going to finish with the market analysis. This is so important to me that you guys understand how this market analysis works and also understand what I'm saying here. Okay, this is a great way to interview a realtor. I'm going to do a market analysis for price per square foot on a subdivision to figure out the price. And then I'm going to figure out the rent as well. Price per square foot is it's a beginner way to look at a whole bunch of data to find a great deal in a short amount of time. And I'm going to show you how to do that. But don't forget, it doesn't always work, right? There's rural property that has acreages, so you can't really do it there. And obviously different markets, different subdivisions, and different conditions of the property. But this is a very, very good tool that I hope you guys pay attention to. And this is basically what I'll be filling out right here. Okay. So I'll be filling this out right here. We're going to figure out cash flow and we'll figure out the wedge. And what I'm going to do is I've already asked you guys what, let me put it up like this, actually. This is what I'm going to do. Okay. Okay. So what I'm going to do is I'm going to do a market analysis from one of the viewers for, what are we going to do? What are we going to do? Okay, Oak Ridge North. Okay, so we're going to do Oak Ridge North. But before I show you how to do a market analysis, I have to first explain to you how hyper local the housing market is. Okay, so here's Oak Ridge North right here. So this is a subdivision. Okay, so this is the subdivision right here. And these are all the homes for sale in the subdivision. This is the subdivision that we are going to analyze. If we went to this subdivision, Chateau Woods, it would be different. If we went to Sleepy Hollow, it would be different. Each subdivision is like an ecosystem. Okay, so each subdivision is its own thing. And because you guys know, because you're smart and you're listening, real estate's super hyper local. So not only is it like state, metro area, city, it's subdivision. Because again, this Oak Ridge North subdivision, y'all, is way worse, quote unquote, way worse than, say, Augusta Pines. Y'all see Augusta Pines down here on the bottom left? So this is why we have to analyze subdivisions. Okay, hopefully, I'm pretty sure that made sense to you guys. So now what I'm going to do, let me go back here. Okay, this is the matrix. This is very easy to use. So you guys see that I want to find data on this subdivision. This is Oak Ridge North. Okay, so Oak Ridge North. So what I have to do first, you guys, is I have to calculate the last 12 months of data. So I want to calculate prices and I want to calculate rent. So what I do is I only want to look at sold property for the last year. Again, if I was buying a house, I would go 3-4 years back, but just for the sake of this video, I'm going 360 days back for the Oak Ridge North community, and I'm only reviewing sold data, which is also another name for comps. And generally, you need 3 comps for the appraisal. Okay, so again, let's go to results. Okay, so 29 properties sold in the last year. 29 properties sold in the last year in the subdivision. Now, what I also like to do is I like to make sure there's no outliers like these two. These two I would consider outliers, okay? Which is basically, this is selling for $378 a square foot. So this comp, if you will, really doesn't belong here, okay? So I would normally remove that. But again, for the sake of this video, I'm going to select all of the data, and then I'm going to go down here to stats, put this in tabular form, and it will automatically tell me what the average price per square foot was, okay? So the average price per square foot for the last year in that subdivision which is really, really interesting, was, okay, let me put this here, 100 and, whoops, sorry about that, guys. Okay, so we need to put this here. It's $152.02 a square foot. Okay, so now what I have to do is I have to figure out the rent. So now that I got the price per square foot, let's look for the rent. I do the same thing. You guys, this is so easier. Basically, all I do now is I go to the rental MLS. This is so easy. I mean, it should take realtors like 10 minutes to do this. So again, I'm going to put the subdivision of, hopefully I copied it. I did not. Okay, I'll just put it Oak. What was this? Oak Ridge North. Oak Ridge North. Okay. And I want all of the sold property for the last year. So I'm going to change this to 360 days. Okay. And that gives us 28 homes that were rented. Let's go ahead and look at the results. Here's all of the homes you can see here that have been rented over the last year from that subdivision. Always look for, like I said, outliers and stuff like that. You guys can see maybe there's a couple here. Do a little bit more research, but for the sake of this video, I'm going to select all of this data. Again, I'm going to go to stats. Okay. I'm going to hit stats right here and hit tabular. So now we know the price, the average price, we'll just take median. So the median price per square foot to rent, you see that, was $109. Okay, so I go back here, $9. And honestly, guys, with this information alone, okay, so with this information alone, I'm good. I can calculate so much information now that I just have $152 and $1.09 for rent. So now that I've equipped myself, let's go find a house to buy in that same area. So what I'm going to do, I'm going to go back here. Okay, am I under, yes, quick search. So I'm going to go here. I want to look at active. So I'm going to go back to the subdivision, Oak Ridge. I don't know why I'm struggling with this name. Oak Ridge North. Okay, and I want to look at the active listings now, only in Oak Ridge North. So let's hit results. And remember, oh, sorry. Okay, so I just hit results right here. I'm looking at Oak Ridge North. Here's the active listings right here. Now remember what I've taught you, and especially if you're an agent, you should be knowing this. So the first thing I'm going to do is I'm going to categorize this by price per square foot because I don't want to waste time. I want to know immediately what house is being, sold potentially for the highest under market value. Now remember, I also don't like big houses. When we do price per square foot, big houses lose value. Okay, so 3,500 square feet is huge. 3,200 square foot is huge. But what do I know? Okay, I know the average price per square foot in the last 12 months was $152. Look at this first comp. This first comp, you guys, is not selling for $152. This first comp is selling for $115. So I'm like, oh my gosh, there's probably a lot of wedge. So let's pull this listing up. Okay, here's the listing right here. All right, it's a new listing. This came on the market yesterday, and maybe they're trying to get a bidding war. So let's look at the condition of this house. They got a jacuzzi. That's, oh my gosh, and a basketball court? What? In a fire pit? And geez, look at, so like normally to get wedge, you have to like upgrade the house. This house is in decent shape. I would paint these cabinets and a couple other things. This is not bad. I'm a little surprised actually. Oh my gosh. This house is in good shape. Okay, so I'm just checking out the pictures. But anyways, let's start with the price. Okay, so I need to put the price down here. Let me do it like this, you guys. So now that I have this info, the first thing I want to do again is I'm going to put the purchase price down, which we know is $415,000. Also, what's super important is having the property square footage so we can start doing our math. So the property square footage is 3,583 square feet. All right. Then I'll scroll down and I'm going to get the property taxes because I want to calculate the payment. So the property taxes, dang it. So I'm sorry about that. So the property taxes, can't believe that just happened, are $5,650 a year. Okay. So right now, what we know is we have enough information. Okay. We have enough information to start doing our multiplications. So now that I have really enough information, all I have to do left is like a couple calculations. I have to figure out the mortgage payment. But let me show you guys how to do your multiplications so that you can figure out market price and market rent. So all I have to do that, okay, is I take this number here times the square footage of the property. And by doing that, I can find roughly the market price. So I take $152.02 a square foot times that 3,583. That gives me a market price of, you guys ready for this? Boom. Y'all, I'm telling you, I could find deals like with prices back in the 2020 range right now. Right now, I could do that. Now let's calculate the market rent. In order to calculate market rent, same thing. I take this $1.09 a square foot and I multiply it by the square footage, which is 3,583 times $1.09 a square foot gives us market rent $3,905. Again, I don't like big houses. I like smaller houses, but that's what we have so far. Okay. So now what we need to do is we need to calculate our payment to calculate our cash flow. The way I'm going to do that is, let me show you. I'm going to go to Google because I don't want to be in any violations here, but I'm going to go to my mortgage calculator in Google. Okay. I'm going to turn on include taxes and insurance. And this is so easy, y'all. I'm going to put in the home price, okay, which we have written down. What is the home price again? $415. So we already know there's wedge in here, by the way. Let's say our down payment is going to be 10% down. Oh my gosh, look at the interest rate that it's quoting. Holy smokes. All right, so let me change the property taxes, which was, what was that again? That was $5,650, okay? Keep everything else the same if you want. Boom, 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 boom. And look at how fast that was. I already have my payment. I'm done. Can you believe that? I'm already done. Okay, so the payment is, let's go back here. Okay, I'm going to put it like this. So our payment is going to be 3,000. Dang, that's really high. $664. I now have enough information to go over wedge and cash flow. So let me first start with cash flow. The way that we get cash flow is we take the market rent that we think we can rent the property out for, okay, minus what our mortgage payment would be. So if you want additional cash flow, you need to get this number down, okay? How do you get that number down? Lower interest rate, higher down payment, a different house, stuff of that nature. But the cash flow is going to be, and it's too low for my taste, but it's going to be a cash flow of positive $241 a month. And remember, this is gross because there could be management fees and things like that. But there's a little bit of cash flow. But now let's figure out the wedge. And the wedge is really, really important. So in order to calculate wedge, we take this market price right here, okay, minus the purchase price. All right, so that's $544,687 minus 415, which gives us a wedge of, you ready? $129,687. Okay, so right now, looking at this market analysis, I don't know. I'm not going to, I don't know if I would do it. The reason is, here's why I don't know that I would do it. My rent payment right now is $2,400. In order for me to get this house, I would have to put down $50,000 and pay $1,200 more a month. So for the affordability aspect, I don't like it. But what I really like about this, look at this wedge. This wedge is insane. It's just the problem is with Texas, you guys, the taxes are so bad here. So when you throw in the property taxes, you lose a lot of that wedge. But if you need to know how I did that, just rewind the video. I know I did it super fast, but either way, we found a little bit of cash flow and we found a lot of bit of wedge. Some of the things that I would worry about in this market analysis is there's a couple comps that were a little bit wild, so I would remove that from an analysis. And then also, again, big houses. Anytime we have big houses, it loses value per square foot. Now, if I was really interested in this house, I'm doing 3 years of market analysis. I'm driving out to the community. I'm walking the property. I'm asking myself, what money can I put in here to increase the value? And I'm going to take it a lot more seriously. But what I just showed you alone, y'all, I'm telling you, if you learn what I just showed you, you're going to be above 90% of realtors. Most realtors do not do what I just showed you. So put that in perspective. It's a great way to shop, like I said, for mortgages. So what I want to do, guys, is let me get to the Q&As right now. I'm so sorry that this is taking so long. I was really trying to be really fast for you guys, really good flow. So let me go back right now. I think I got a super chat too. Thank you so much, Trey. The haters won't like this. Have a cup of coffee tea on me, but Trey, you don't have to do that, man. Stop, Trey. I want you to get a cup of coffee for someone that you see that's struggling. And if you really want to be all out, go pray for them. And if you don't believe me, watch and see what happens. Like if you see someone, you say, "Hey, can I pray for you?" Watch what happens. But brother, thank you. I appreciate that. Megan. Welcome to being a member, Megan. Being a member is just really more about support. It only costs $1 a month. You guys don't have to do that. Usually I just am insecure in my member section, but I am working on a course, home buying course. It's going to be one of the best courses you guys ever take, and it's going to be free. It'll be free. Couple things here, you guys. Travis, use the average single income. The reason I didn't do that is because then you would see that no one qualifies for anything. In fact, you have to be a couple almost to even maybe afford a house. So it'd be way worse. Meanwhile, the median household income in the US is 74,000. So it's important to understand the only reason why I was using 100,000 is because that's supposed to be a lot of money, right? That's supposed to be a decent amount of money to make. And it's a nice even number. AJ says, these are all the classic signs of a recession. Metals going down, the dollar going up, stocks go down, bonds go up, but this time is different. I mean, and even people saying that this time is different is an indicator of a recession. When people say this time is different, usually it's a bad thing. Okay, this is House Hacker. House building sentiment is bad. Now they will have to slow down with building. That's not necessarily a good thing, right? Even though they have, and I just did a video on new construction, we have so much inventory for new homes. Overall, not in House Hacker's market. And I flew to San Diego and I went to several communities. San Diego's in a mess, and that's where House Hacker is. But House Hacker and I were talking yesterday, and really what his main thing is like supply, right? He's like, I don't care what Travis says. If we don't have supply, prices aren't going down. And that's a fair point, right? Why would I be upset? That's a really fair point. But my rebuttal to that is Phoenix. Phoenix has, I think, almost the entire year has had 3 months or less of supply. Again, 3 months or less of supply, and yet they've continued decline. In fact, they're I think, what is it, 4% under year over year and $41,000 off of peak. So the reason I'm saying all of this, and House Hacker, thank you for talking to me. I'm not knocking you at all. You help make me stronger, so understand that. But what we know is it's not just supply. There are other factors, although supply is so important, so important. And when we get the supply back, what do you think is going to happen, right? When we get it back, what's going to happen? But also what's important, and I found this in Texas when I've analyzed all the metro areas out here, the equity run-up and unaffordability do play a role, which is why I don't know, that's probably why I befriended House Hacker, and him and I are talking, because I'm so infatuated with San Diego, and I'm from SoCal. So San Diego is like the epitome of unaffordability and the epitome of equity run-up and like the epitome of no inventory. But also, House Hacker, remember, San Diego was on the year-over-year price decline list, and I think it's still off of peak. Let me know. I'm not sure, though. Appreciate you, brother, House Hacker. Thank you for joining us, man. This is a comment from Christopher. Buyers are foregoing and trusting builder inspections rather than getting their own. That's ridiculous. Afford the house, but not the inspection. You got to do independent research, y'all. You can't, in my opinion, you can't use that, in my opinion. Here's another comment. Here's another from Froxy. Will renting be more affordable? Will there be more choices in this area? So I'm not sure your area, but one thing that I know confidently, Froxy, is the inventory for rentals right now is skyrocketing. Unprecedented amount of inventory hitting the market in the long-term rental. And then also for the bans and STR, short-term rentals, that will have an effect. Another comment from Comic Lover. Okay, yeah. So I explained this when this was about the amortization schedule. Comic Lover, I got to do a bunch of math to figure that out, but hopefully you guys understand the amortization schedule. I'm going to get out of here. I knew this would go over an hour. I'm sorry, y'all. Hope you guys have a great day. I will see you tomorrow, but I will not see you on Friday. And other than that, if you are out there investing in real estate, you guys already know, I wish you luck, and I hope you